Welcome to another edition of Selling Life and Annuities. I'm Tim Luby. I'm the National Sales Director for Annuities here at Gordon Marketing. And with me today is Paul Bechtold, my good friend. He's the Regional Vice President and Manager of our Debt Elimination Programs. Today's topic is debt consolidation is not a solution. But isn't it better to have lower debt, less debt?
Well, that's a common theory, okay? And on its face, you would think that the fewer debts I have, the easier it's going to be to pay them off. Especially when, say, I'll give you an example. College grads come out of school. They got several student loans. They've acquired them semester by semester, year by year through college. So they got 10, 12 student loans. They get hit by debt consolidation companies to combine them together under the guise of a lower interest rate, right?
Right.
The problem with it is that you lose flexibility in the dynamic of what we call debt snowballing. All we're doing when we consolidate debts in many instances is we're combining them together for one much larger debt that's going to take a lot longer to pay off. And we lose the flexibility of what we call debt snowballing to pay them off more quickly and accelerate them. So, for example, the college grad that comes out of school would be better off to keep the 10 or 12 debts that are smaller, okay, make the minimum payments on those debts, and then take any excess money in their economy and put it into our program. And then as the debts get paid off, they take that payment and they add it to the next one. And then they take the two payments and add it to the third one and so forth, so that they're getting their money to accelerate and snowball and work for them faster. When you have one debt, I'm stuck with one bigger debt that has a bigger payment, and it stifles my cash flow and my flexibility. Does that make sense?
It does. So I have to believe that some of the allure behind the debt consolidation programs is a reduced interest rate.
Absolutely. Yes, correct.
And a reduced interest rate is a good thing to have, right?
Well, the answer to that is it depends. It depends what kind of interest we're talking about. It depends whether it's variable or it's fixed. It depends on what kind of a balance you're talking about. Also depends on the economics of the individual that is trying to pay that off. I mean, if they don't have much cash flow and they're really stuck with this bigger debt, they could be living with it for a while. The other thing is there's things like, let's go back to the student loans for a second. Student loans are negatively amortized for the first 5 years of that loan, okay? So for the first 5 years, they're not even paying all the interest. So you have interest accruing on the interest plus principal, and you're not even beginning to touch the principal for 5 years. Those are designed to last for 40 years and can absolutely bury a young person that's just making the bare minimum payment on those debts, okay? So think about that. The 22, 23-year-old coming out of college is knocking on the door of retirement before those student loans are gone.
Yeah, that's incredible.
Okay.
So this debt consolidation is big business, right?
Absolutely. You wouldn't be hearing the commercials you see on TV, and you wouldn't be seeing all the advertising if it wasn't. Do you think that a financial institution would actually be going out there and promoting something that's in the better interest of the client than it is the financial institution, which always has a bank behind it?
Right.
Okay.
So that's interesting. So why do we see so many offers and that kind of thing if in effect it doesn't work very well?
Well, it does work in the short run in terms of what I call the kick down the can kind of mentality. There's a lot of things going on with people's debts right now. For example, student loans are in deferment, right? But people sit there and they don't make any payments on them. They're accruing more and more interest, okay? All the bank really cares about at the end of the day is, are they making interest off of your debts and off of the money in your economy? And if the answer to that is yes, they will come up with a whole, any number of different financial solutions out there that they present to people that are more to their benefits than they are the clients. Right. So, they can appear to be effective, but in the long run, it's always more in the bank's favor.
Right. So you've talked a bit about student loan debt, and so what is the best way for someone to pay off student loans?
Well, the first thing I would recommend anybody do, especially student loans, is for example, get a hold of somebody who really understands how interest works. We can help with that through Equity Excel. First thing I do is always re-amortize them on a 30-year timetable with a straight amortization. Okay, I have them make that minimum payment on those debts, and then I start looking for money in their economy to redirect, so that we can start attacking that debt and sequentially paying each of those student loans off. The second thing is, but by all means, don't consolidate those debts. Keep them separated out, and that combined along with the other credit card debts they may have, their auto loans and whatever. You'd be surprised, we could take that 40-year time frame I was talking about and we can turn it into 6 or 7 years.
Wow, that's significant. So, one of the keys you talked about early on was credit score and credit worthiness in terms of. So how can someone improve their credit score? Because I think part of the allure of debt consolidation is to improve their credit. But there are other ways to improve their credit, but short of a debt consolidation. What are some of those?
Well, one thing that people have a misnomer about is and been taught by the Dave Ramsey's of the world, cut your credit cards up. That's one of the worst things you can do. Pay the credit card off, but keep the credit card open, because the open line of credit with a paid off balance is going to greatly improve your credit score. So getting your debts paid down, being timely on your payments, reducing your debt to income ratio, all those factors work together. And people can rapidly improve their credit score in a 6-month to 1 year period of time, a lot faster than they think possible. You can go from a 500 credit score to over 700 easily within 6 months to a year.
Wow. With just making a few of the right moves, I would gather.
Absolutely.
Right.
Just basic financial common sense, I would like to say.
It's good stuff here. Great information. So for the benefit of those agents watching us today, what is the best way for them to engage with you, to learn more about how they can help their clients with this stuff?
Well, if this is of interest to you, contact me at paul@gordonmarketing.com. Also, I have my cell phone with me 24 hours a day, pretty much 24/7 guy, 317-626-3054. Be glad to answer any questions for you. We can run a sample case for somebody has this kind of situation we're talking about, and let the proof be in the pudding. Let the numbers speak for themselves. I think you'll be surprised at what we'll be able to do for you and your clients, and for you as the agent out there. Put a nice check in your pocket along the way.
Great. Thank you, Paul. So it looks like our time is kind of winding down. We've come down to the wire on this. But if you would, please do us a favor and subscribe to the video, so the subscribe button below, and hit the notification bell so that you'll be notified every time a new Selling Life and Annuity video comes out. And as always, if you'd like, comment and share our content with people. If you're enjoying what we're providing, that would be great. And with that, thank you for your time and attention today, and happy selling.